and thank you to everybody who's joining us today to hear about the Brunner Investment Trust. My name is Julian Bishop. I'm the co-lead manager. And just in the next 15 minutes or so, I'll take you on a brief journey through what the Brunner Investment Trust is, what we do, and hopefully at the end there'll be some time for any questions that you may have. Just as a very brief introduction, the Brunner Investment Trust is a global equity investment trust. We have a slightly unusual benchmark in that the benchmark is 70% FTSE All World, which is a global equity benchmark, and then also 30% FTSE All Share, which is a UK benchmark. So the idea really is that it's a one-stop shop for a UK-based investor who wants some exposure to all the value in the domestic market, but also plenty of exposure to all the growth that exists in Europe, US, Japan, and wherever else it may be. The Brunner Trust was founded in 1927, so we've been going nearly 100 years. It was sold when Sir John Brunner sold his chemicals business to what actually became ICI. It was one of the four founding businesses that came together to form ICI, and he took his family fortune and created the Brunner Investment Trust at that point. And the Brunner family actually still have about 30% of the trust, and it's really run on that basis as a family investment, intergenerational, long-termist, etc., etc. We're a decent size, so our AUM, our assets under management, just short of £600 million sterling, which is a decent amount. We're a AIC dividend hero, so we have a 51-year record of increasing the dividend every year, which is something that we're really proud of, and we have absolutely no intention of breaking anytime soon. We have a reputation for consistency, so we've just celebrated 5 consecutive years of outperformance versus our benchmark net of fees, which we're very pleased about, and which is very, very unusual given the huge swings in the style of the stock market over the last several years. And for that reason, we call ourselves an all-weather investment trust. As we see, we will show you, we try to combine as much quality, as much value, and as much growth into the portfolio in one. We prefer not to be pigeonholed as a quality manager, as a value manager, or as a growth manager. We see those as 3 sides of a triangle that needs solving for, and we try and get as much quality, as much value, and as much growth into the portfolio as possible, rather than having a very, very strong stylistic bias. 100 years of experience, so there's 4 of us. There's 2 co-leads, of which I'm one, and 2 deputies. Between us, we have 100 years of experience, and then in addition to that, we call upon significant internal resources of Allianz Global Investors, which is the firm that employs me. So if you're unfamiliar, investment trust generally will employ a fund manager to run activities on their behalf. So I'm an employee of Allianz Global Investors, even though my primary job is to run the Brunner Investment Trust. We have a little bit of gearing, so you may be aware that investment trusts are set up legally very much like a company. So we have a board, we have an annual general meeting, we have a company report, and we're also allowed to take on a little bit of debt. And the idea is that that will boost returns slightly over the long term, assuming that the returns on our equity investments exceed the cost of debt. And the debt that we have is very, very low cost. We pay under 3% interest rate on that debt, and it's fixed through to 2048. So that's a really good long-term small piece of debt that will modestly amplify any returns on equities over the period to come. I mentioned the dividend record. So this chart shows that our record of increases goes back to 1972. So that's slightly older than me. That's 2 years longer than I've been alive. So it's a terrific record. Another feature of investment trusts is that we can accumulate reserves. So in a year when we receive more income in from dividends than we pay out, we build that reserve, and then we can release it in years when there's a downturn. So the last time we depleted the reserve was during COVID, when a few of our companies did cut their dividends. But over the long term, it's allowed us to maintain our dividend and maintain that record of increasing the dividend payouts every year. It's been ahead of inflation over the long term. At the moment, we have a reserve which is equivalent to 1 year's dividends or over 1 year's dividends. So if there is a rainy day in the future, we can continue to pay out that dividend to you. We pay quarterly, and we have one of the higher yields in the global equity universe at 2.2%. Worth noting that that's a relatively low number compared to, for example, UK income funds. Several reasons for that, one of which is that in the United States, there is a preference in business to do share buybacks, which is another form of cash return. And also, we're really a pretty strongly growing portfolio as well. So if you look at the last 10 years, for example, the Brunner Investment Trust has returned 12% a year, including the dividends. So most of the return has come from capital growth as opposed from income. This is our track record. So the light blue line at the top shows the Brunner Investment Trust share price, and the green line shows our benchmark. It's obviously been a good period for equity markets. It's been a good period for Brunner. So the share price essentially up 200% over 10 years compared to our benchmark of 150%, so 50% ahead of benchmark. As I mentioned, we've achieved that with reasonable consistency. So some trusts have more of a stylistic bias, which means that maybe 1 year they're very, very strong versus benchmark, and then the next year they're considerably behind. We've avoided that drama of being far more consistent in the way that we've delivered our returns. So moving on to the team and process. I mentioned the four of us, 100 years of experience. So there's myself and Christian Schneider, who are the co-leads, and we are supported by James Ashworth and Simon Gergel as deputies. Worth pointing out, Simon Gergel, he's the deputy here. He's by no means junior, neither is James. You might know Simon Gergel if you know the Merchants Investment Trust, which is also run by Allianz Global Investors. So he's a very seasoned UK investor who provides us with great input into all things UK related. The other three of us have got more of a global background, so we're looking at companies no matter where where they're listed. I mentioned our ability to call upon significant resources, so it's not just the four of us. We work for Allianz Global Investors, not a particularly prominent company in the UK. Allianz, of course, huge German insurance business, but also have a very, very sizable asset management arm with over 400 billion AUM. We are in regular daily contact with all the different teams. And it's our job really to cherry pick the best ideas from around the business and bring them into the investment trust. I mentioned already that it's our intention to balance quality, value, and growth. So what we always say is that we have a strong preference for quality, a strong preference for growth, and we have a strong preference for valuation. And we try and optimize the portfolio for those three often mutually exclusive factors. By quality, we'll give some examples in the slides to come, but really we're talking about businesses with sustainable competitive advantages. So often businesses with unique abilities, very strong balance sheets, anti-fragile businesses. So we look for businesses which are robust no matter what the macroeconomic conditions are, for example. Sound ESG factors, shareholder-friendly capital allocation, and plentiful free cash flow generation. Secular growth, we want as much as possible. So we look at growth in end markets. We look at a way a company's revenues and sales might be linked to inflation. Look for companies with demographic tailwinds. We look for businesses that we think will be around for more or less ever. So we look for companies which we think have perennial relevance. We take a very long-term view, so some very good businesses are cyclical. We're never trying to time cycles, and we avoid businesses which we think may be suffering from structural decline or disruption. And then on value, we firmly believe value is more than just a low PE multiple or a high dividend yield. We're focusing really on the quantity, the trajectory, and the riskiness of cash flows for all of our businesses. So where we do have businesses which have good dividends, that tends to be an output of a good business that generates lots of cash. We don't screen for dividends per se. They are what's left over by a business that generates lots of cash and has no alternative reinvestment uses for it. This chart, let me just check time. So I just want to make sure I'm sort of reasonably on budget. This chart shows the type of businesses that we invest in the context of a business or industry life cycle. So on the far left, you might have very sort of nascent emerging growth companies that have somewhat uncertain business models, often make a loss, and represent, in our mind, generally very high risk return. We don't really participate there at all. We have a very firm rule that we won't invest in businesses that don't generate free cash. The core of the portfolio really is in sort of steady growers. So these are businesses that are proven winners in their space, strongly profitable, that have good consistent growth, but maybe not growth exciting enough to send valuations into a frenzy. And typically for these businesses, you get your return as an investor in two ways. You get them from a mixture of cash returns and a mixture of earnings growth. So the classic Brunner holding would probably generate at the moment a free cash flow yield of 4 or 5%, and that would be growing in the region of 5 to 10% per annum. And if you add those up, that's how you get to a total shareholder return of 10 to 15%. And history of the trust is we've done about 12. Valuations may change, so valuations may expand or contract. Over the long term, I think for the types of businesses we're invested in, that's not a huge opportunity or risk. Most of our return is going to come from cash and from growth. And we're really looking for businesses which we think can grow steadily, consistently, and with a reasonably low risk profile. But at the margins, we also do have some faster growth companies where the pace of growth will be a lot higher. Sometimes there the valuations are a bit more expensive, but we generally think we're talking about businesses that are absolutely best in class with very good long-term opportunities, which can easily grow into their multiples with time. And at the other end, we're also quite happy to hold a portion of the portfolio in more mature cash generative businesses. So businesses where we think they have a terrific competitive position, but perhaps the end market is mature, but they throw off lots of cash, which they can return as dividends and as share buybacks. A lot of funds talk about themes, for want of a better word, or structural trends, and we like to see as many of those in driving our growth as possible, but we're not looking for them specifically. First and foremost, we're looking for good businesses, and I think the reason is because just because a business is big or the market opportunity is big does not mean that there will be a profit pool there. I think a good example of this is Microsoft and Volkswagen. So believe it or not, Volkswagen's sales are higher than that of Microsoft. Microsoft is worth $3 trillion. Volkswagen is worth 60 billion. So Volkswagen has higher sales, but Microsoft is worth 50 times more. And that's because it's more profitable, it's a better industry structure, and the market is willing to put a higher multiple on that business because it sees it as competitively more robust and better with better prospects. So we argue it's business quality first and then the theme that matters. So as an example, these are 3 holdings that we have in the travel sector. So travel is a growth industry. In each instance here, we think we have invested in absolutely world-class businesses with terrific industry structures. If you take GE as an example, so GE, famed rise, famed fall, example of corporate hubris. Essentially over the last decade, GE has been dismantled by management. And as of next month, the only business that will be left to all intents and purposes is a jet engine business. Now, the tech in a jet engine is absolutely extraordinary. They're amongst the most complex machines on planet Earth. The barriers to entry are absolutely huge. There's an obvious necessity for reliable and complete safety. Believe it or not, 75% of all flights that take off worldwide are powered by a GE engine. And all that profit comes from predictable recurring service revenues at around 30% margins. So as long as that engine is flying, GE are getting paid, and they're getting paid for the life of the engine, which is generally over 25 years. Got exceptional pricing power, low capital requirements, and there's growth. There's growth in the aircraft fleet. Most years, the global aircraft fleet expands, and also they're able to put through price increases every year. So very cash generative, very visible long-term growth. Aena, I won't go into too much detail, but they essentially own every airport in Spain, so they have a monopoly over all air travel into Spain. So a unique monopolistic position that puts them into a very strong competitive position. And then IHG Hotels, which is a franchise business essentially. So they lend their brand to hotel owners and take a fee for it. And that fee is linked to hotel sales. So as long as the hotel is operating and open, they will get paid. And that fee stream is assured under 20-year plus contracts. And the margins on those fees are absolutely extraordinary, over 50%. And there is growth in hotel nights. There's growth in air traffic travel into Spain. So all these fantastic business models are supported by structural growth. Similarly, artificial intelligence is obviously getting a lot of media attention at the moment, getting a lot of investment attention as well. I think we broadly concur that it's going to be a very large market. It's a pretty exceptional technology. We think it drives the next leg of growth in semiconductors and in some parts of software in particular. We have 3 world-class businesses invested in that area, which we think combine terrific barriers to entry, business economics, and then now supported by growth in AI. So if you take Microsoft, I at the moment am doing this webcam on this webinar on a Microsoft PC. There's 400 million Office 365 subscribers around the world. They have an incredible relationship with every corporation in the world, very sticky customers. I often joke that the global financial system would pretty much collapse without Excel. And because they got that incredible relationship, they got that stranglehold on the Office user, they can roll out new products, new features to their client base and monetize them. So recently they've had great success with Teams, which is used to allow office workers to communicate by a message and by video calls. They also have now a product called Copilot, which essentially brings AI functionality into the office. So I was reading a note. I was writing a note recently on a Dutch semiconductor company, and I asked Copilot to write me a couple of paragraphs on a very obscure part of semiconductor manufacturing. It did a very good job, and they will charge an extra $15 a month for that. You roll that out across 12 months and across 400 million users. The market opportunity is very, very large. And the software business model is just absolutely exceptional. So most companies, if they sell one more of a product, they need to make one more of that product. So Nestle, if they want to sell one more Kit Kat, need to make another Kit Kat. Microsoft, if they want to make another version of Office, they just need to press a button and it's digitally distributed with no incremental cost. So it's an extraordinary business with incredible profits. Great growth there as well, increasing knowledge workers, price increases, the upsell of those optionality, so those things like AI functionality teams, that allows them to grow very, very consistently. And they also have leadership in cloud computing, which often hosts AI functions in the cloud by their business, which is called Azure. Another thing to be aware of with artificial intelligence is it's very, very computing intensive. It requires a lot of silicon, a lot of semiconductors. Pretty much all the leading edge semiconductors in the world are made by one company, which is Taiwan Semiconductor Manufacturing Corporation, and we invest there. And they are very, very reliant on machines made by ASML, which is a Dutch semiconductor capital equipment company which makes probably the most complex machine tools on planet Earth. They cost 200 million. They have absolutely incredible technology operating at the very limits of physics. They have a complete monopoly on what they do, and they have profit margins and economics that go with that monopolistic position. So essentially, they're just resistant from competition. And in all three of those instances, those businesses are going to be supported by growth in AI. Somewhat more prosaically, I mentioned that we like value and we're quite happy to have more mature businesses in the portfolio. I think a good example here is Bank of Ireland, which is a recent addition to the portfolio. Bank of Ireland, we think, can generate its, well, 40% of its current value in cash and return that to shareholders in the next 3 years, which is an extraordinary amount of money. So essentially, after the financial crisis, the Irish banking system was more or less bust. And we quite like banks that have basically been through this crisis because the regulator becomes very tough. They recapitalize, they reduce the risks, they reduce the leverage, they lend far more sensibly. So we think the bank today is in a much better place than it has been in the past. But it's taken them 10 years, 10 years on from the crisis to rebuild their balance sheet. That's been very costly. And now they're in a position to start returning that cash to shareholders. So that's an exciting new addition to the portfolio. And just goes to show that we like to mix both value, quality, and growth. And we think at the moment, in certain parts of the market, the unfashionable parts of the market, and banks would probably be a good example, there are some really pretty compelling opportunities. This is what the trust looks like at the moment. So our largest holding is Microsoft. Then we have other companies, Visa, the payments network, mentioned Taiwan Semi, Intercontinental, as other examples of our holdings. We have a lot of exposure to industrials, financials, tech, and healthcare. They're our biggest weights. That accounts for more than 75% of the portfolio. At the moment, we're in about, US is about 42%, UK 24%, and then we have a good smattering across most of the European countries, and Japan, Taiwan, and some in Hong Kong as well. So just to reiterate, so we have a preference for quality, but we want to balance that with strong valuation discipline. We've delivered very consistent returns. We've got a very good track record of providing growth in both the income and capital, so 12% return compounded over 10 years. One of the highest yields in the sector, 51-year record of increasing the dividend, and an experienced PM team supported by the global investment platform here at AGI. And with that, back to the studio. Very happy to take any questions you may have in any remaining time that we have.
Okay, Julian, thank you very much indeed for the presentation. We only really have a minute or two left, so I'll be quite quick with the questions. So if you can also have quite quick answers.
Sure.
The first one's about the geographical weighting, and you described at the beginning the global and UK indexes. Have you increased or decreased the international exposure, and what's your outlook? Are you constrained by that, or do you have ratios that you have to abide by if you want to increase the US, for example? Can you do so further?
Yeah, I mean, we're pretty free to go where we want, and I think one of the great things about being global is you're never constrained by geography, sector. So if we find what we think is an exciting investment idea or an extraordinary company, we can buy it irrespective of where it's listed. And we're very bottom up. We're really looking for great companies. So to a certain extent, where they are listed, we don't really pay that much attention to it. We don't particularly care. The one thing we are conscious of is that we have this benchmark, which is 70% global, 30% UK, and we do think it's therefore important to have a reasonable component of the portfolio in the UK, and we're at 24% at the moment. But a lot of those UK listed names, they're very international businesses. Most UK listed businesses are. So we don't want to buy UK just for the sake of it. We don't see that's particularly important. But there are some advantages to investing in the UK. So overall, the market is pretty good value, and there's a very strong culture of dividend payments. which is good for helping us meet our yield objectives. And then, worth being aware, obviously we have to be aware that there are different taxes that we pay on the dividends before we can return them to you. And we don't pay any tax on dividends on UK stocks. And in most markets, we probably pay 15% on dividends in the United States, for example. So it makes sense in a lot of opportunities, in a lot of instances, to skew our holding to the UK if there is a business that maybe has an analog in a different market. It might make sense for us to buy the UK variant, if you like. So we mentioned continental hotels. We could have bought Marriott in the States, but here we get more dividends and we pay no tax on it.
Okay, a couple of quickies, please, Julian.
Sure.
How much of your time do you devote to the Brunner Investment Trust, and are you a holder? Do you own any?
Yeah, absolutely. So I have skin in the game. I believe in it a great deal as a product. So I have it in my SIP and my ISAs, got it in my kids' SIPs, and also don't got SIPs, I've got ISAs. Wife's ISAs. So yeah, I believe in it and participate, and see it as a great core long-term holding.
Is the question about how much time you devote to it? Is it your sole fund, or do you have a portfolio of funds you look after?
It's not my sole fund, no. So I'm also involved in a global dividend fund and a European growth fund, but both Brunner sources ideas from both of those. So there's a great deal of overlap. I would say probably 75% of my time is spent on Brunner.
And final question then, given the time, apologies for not asking more. It's about tech valuations. It's given your 42% exposure to the US and especially tech. Are you concerned about rich valuations at which these equities are trading?
Yeah, I mean, well, I would say most of these very large tech companies, and certainly the ones we're invested in, they're all incredible businesses. So this is not like the dot-com bubble. This is, where there are sort of fantasy profits and revenues even. From Nvidia to Microsoft, they're all absolutely outstanding businesses. They've all seen multiples come up quite a bit, especially in the last few months. I think I've just written on monthly newsletter. I said, to me, they're getting to the higher end of comfortable rather than anything more sinister. And what I've shared is that we're committed to taking action if we ever see things getting into irrational territory. But I think at the moment, things broadly okay. They're incredible businesses with great growth opportunities.
Julian, thank you very much indeed for joining us this evening.
No, thank you very much, Ron. Thank you to everybody who's listening for your time.